Today we're tackling a massive stack of source materials, really, all about income, benefits, and of course taxation.
Right.
And what we're really trying to do is find those lines in the sand.
The gray areas.
Exactly. What actually counts as taxable income and what is, legally and completely exempt.
And this is such a crucial area. I mean, these gray zones and benefits and allowances, this is where most people end up making some really costly mistakes.
I can imagine.
So our mission today really is to distill all this down. We want to establish some clear rules, differentiate between, say, your standard wages and a gift.
Okay.
Or between a business allowance and, critically, the difference between a mandatory and an optional retirement payout.
Okay, let's unpack this, I think. Let's start with the most foundational thing. The basic separation in the tax world, which is distinguishing between two different types of assets when you sell them.
Good idea.
We have to set the scene for just how complex taxes can get before we even touch exemptions.
Right. And with real property, it all hinges on one question. Is that property an ordinary asset or a capital asset for the person selling it?
And what's the difference?
Well, if you're a dealer, a developer, basically if your business is buying and selling property, then for you, that building or that lot is an ordinary asset. And the taxes they stack up immediately.
How complex are we talking here? Give us the list. What taxes hit a dealer when they sell a property?
You're looking at a minimum, 5 different kinds of taxes all at once. Because it's pure business income. So you've got your 12% value-added tax, the VAT. You've got a general business tax. You have your standard income tax on the profit.
Of course.
And since that income is taxable, a chunk of it is immediately hit with withholding tax. And then finally, because you use a deed of sale, you have to pay the documentary stamps tax.
That is a staggering list.
Yeah.
And it confirms that, money made from commercial activity it's heavily scrutinized.
Heavily.
So let's completely switch gears. Let's look at money that comes in, but it doesn't feel like a business transaction at all.
Precisely. Let's use your birthday example. Someone gives you, say, 10,000 pesos.
Okay.
It's just out of affection. You're wealthier, sure, but did you earn it?
No, I definitely didn't work for it.
And that is the absolute key. The rule is simple. A gift given out of pure generosity or liberality is exempt from income tax.
Why?
Because the money wasn't derived from any kind of activity. You didn't get it from compensation or labor or commerce. The source isn't clear on this. It came from kindness, not effort, so it's not income.
So the fundamental test is whether the money is the fruit of labor.
That's the test.
Okay, if that's the test, then where does the line start to get a little fuzzy? I'm thinking about people who get income extras, like in the service industry. Let's talk about tips.
Right. So a barber, a beautician, a server, they get a tip directly from a customer. That tip is, without a doubt, the fruit of labor.
Because you got it for the service you perform.
You got it because of your employment. Therefore, tips are subject to income tax.
Okay, the test holds up. But does it matter who gives the tip? The customer versus the employer. Does that change anything?
It changes the withholding process, which is a really vital distinction for people to understand.
How so?
If the tip is paid directly by the customer to you, it's exempt from withholding tax. Your employer doesn't touch it.
But you still have to declare it and pay income tax on it later.
Correct. But if the tip or a commission or an allowance is paid by the employer, then withholding tax applies. They take the tax out before you even see the money.
That's a huge difference for your take-home pay. Okay, let's keep going with this. Let's tackle allowances. Specifically those big ones, like for transportation or representation. So imagine a field worker. They get a 60,000 peso allowance every month to travel, show catalogs, meet clients. Is that whole 60 grand just taxable income?
This is one of the biggest gray areas, and the answer depends entirely on one requirement: liquidation.
Okay, walk us through that. What does liquidation mean here, and why is it the deciding factor?
Liquidation just means the employee has to account for every single peso.
Receipts, logs, everything.
Everything. Show your receipts, log your mileage, report exactly how that 60,000 was used for the business. If liquidation is required, it proves the employee is just a pass-through. They're basically borrowing the company's money to cover the company's expenses.
So if they spend, say, 50,000 and have to give the extra 10,000 back to the employer,
then the full 60,000 is not taxable to the employee. It was just a temporary advance.
or reimbursement.
Exactly. It's a reimbursement, and reimbursements are not income. However, if there's no liquidation required, if the company just says, here's 60,000, manage your travel, keep what you save.
But if you go over, that's on you.
Right. Then that entire amount is considered part of the employee's compensation.
Because they have control over it. The government sees any extra as supplementary income.
That's it, exactly.
Right.
No required return of excess funds means the whole $60,000 is taxable, whether you spent it all or not. It's the key difference between compensation and reimbursement.
That clears up a lot. Let's move to money you get at the end of a job. Monetized leave and separation pay. Let's start with a private sector bank employee. They convert, say, 14 days of unused sick and vacation leave into cash.
For the private sector, we run into a very, very specific rule. It's called the 10-11-day rule.
The 10-11-day rule. Okay, is there a reason for that specific cutoff?
Well, the thinking is that the government wants to give a small tax-free benefit, but without encouraging people to never take a day off. The whole point of leave is rest.
So what's the rule?
If you monetize 10 days or less, that cash is exempt from income tax. But the moment you monetize 11 days or more, like in your 14-day example, the entire amount is immediately subject to income tax.
Not just the amount over 10 days.
No, the whole thing. It's a cliff.
Wow. So it incentivizes you to either take your vacation or keep the cash out low. What if that same employee worked for the government?
Then that 10-11-day rule, you can just throw it out the window. It doesn't apply.
At all?
Not at all. For a government employee, whatever amount of leave they convert to cash is exempt from tax. Period. And what's more, they often accumulate leave for their entire career, and that final payout, called terminal leave pay, is also completely tax exempt.
That's a pretty powerful reason to stay in public service.
It is.
Okay, let's get into a more emotionally charged topic. Separation pay. Money you get when a job ends suddenly. And the taxability here, I understand, depends entirely on the fault rule.
This is so critical. Separation pay is exempt from income tax only when the termination is for reasons completely beyond the employee's control.
Like what?
Think involuntary separation. The business closes because the owner died. The company has massive downsizing. The whole family that owns the company decides to migrate. The employee is completely faultless.
And what if that happens to someone more than once? They get laid off, get exempt separation pay, and then years later it happens again at a different company.
The exemption applies again. And again, as long as you are not at fault, the separation pay is exempt. It can happen multiple times in a career.
Okay, now the flip side. The employee is a problem. Can't follow orders, has a bad attitude. The company just wants them gone and offers a financial assistance package to get them to leave quietly.
Because the termination is the employee's own fault or they voluntarily accept a buyout, that financial assistance is taxable income.
It's not considered separation pay.
No, it does not qualify for the exemption.
I want to clarify one thing that gets mixed up with this. Back wages. An employee is illegally fired, they sue, they win, and the court awards them back wages. Is that taxable?
Yes, always. Back wages are always taxable.
Well,
View is that it's just salary you should have earned, but it was delayed. And salary is always taxable, so back wages are too.
got it. And one last very niche case the sources mentioned, political staff. The quarter-minus employees who have to leave when their politician's term ends.
That is explicitly exempt from tax.
Because it's beyond their control.
It's completely involuntary. Their job is tied to a political cycle, not their performance.
Excellent. Okay, let's pivot to the final payout. Retirement benefits. Starting with the standard mandatory retirement benefits from, say, SSS or GSIS.
Any mandatory retirement benefit, whether it's from the government's SSS or GSSS or a private company's fund, is exempt from income tax.
And the golden rule.
The golden rule is if it's exempt from income tax, it is automatically exempt from withholding tax.
Now, the mandatory retirement ages are different, right? I think it's 56 for police and military, 60 for the private sector.
0.65 for general government employees and 70 for the judiciary.
Right. But regardless of the specific age, if you hit it and retire, the benefit is exempt.
Correct. And this is true even if you get multiple benefits at once. Imagine a prosecutor who also taught at a private university part-time.
Okay.
They might get a payout from the government service system, another from the Social Security system, and a third from the university's private plan. If they've stopped working, all three can be exempt.
That's a huge relief for many retirees. But here's where the planning gets really, really tricky. Optional retirement.
The early retirement packages.
Exactly. Companies use them to cut costs. They offer them before you hit the mandatory age. So when is that early payout not taxable?
It's only exempt if it follows the very strict 50-10 rule. And you have to hit both criteria. No exceptions.
What are they?
First is age 50. You have to be over 50 years old, but still below the mandatory retirement age. Second is service, 10. You must have worked for more than 10 years with that exact same employer.
So let me get this straight. I'm 49, but I've been with the company for 20 years. My benefit is taxable.
Taxable, you didn't meet the age requirement.
Okay, I'm 55, but I've only been there for 8 years.
Still taxable. You didn't meet the service requirement.
You have to hit both.
Both must be met. But if they are, the benefit is exempt from both income tax and withholding tax. But, and this is the critical caveat,
There's always a catch.
this exemption for an optional retirement benefit, you can only use it once in your entire lifetime.
Oh, wow. That is a massive detail. So if you take an early retirement package in your 50s,
And you use that one-time tax exemption.
you can't use it again. Any future optional retirement offers you get will be fully taxable.
Exactly. It forces a really serious long-term career calculation. Is this early retirement package worth using your one and only lifetime tax shield?
That's a tough call. Okay, finally, let's talk about who can even grant a tax exemption. We hear tax-free all the time. Tax-free prizes, tax-free benefits. Who actually has the power to do that?
Only the legislative branch, Congress, the lawmaking body. They're the only entity that can grant a true tax exemption through law. That's fundamental.
So not the Bureau of Internal Revenue, the tax agency.
No, they just implement the law, they don't write it.
And what about private companies? A bank offering tax-free retirement? Or a game show host promising a tax-free prize?
They don't have the authority. They can't grant a legal exemption. When a private company says tax-free, what they really mean is that they will pay the tax for you.
So they're just shouldering the tax burden.
Yes. They're making sure you get the full promised amount in your hand, but they aren't changing the law. They're just shifting the tax costs to their own books.
So what does this all mean for someone just trying to manage their finances? We've figured out that the tax on an allowance depends on liquidation.
Right.
The tax on separation pay depends on the fault rule.
Who's to blame? Yes.
And these really crucial exemptions for monetized leave and optional retirement, they depend on these super specific thresholds.
Yeah.
The 10-11-day rule and the 50-10 rule.
The big theme really is that the reason you got the money is more important than the amount. Was it from effort, from your job? It's probably taxable. Was it from generosity? Probably exempt.
Was it a reimbursement or was it extra income?
Exactly. Knowing these details lets you plan your finances with your eyes open.
And since we now know that tax exemption authority rests only with Congress, you have to think about the consequences when you see a company advertising a tax-free prize or benefit. If only the legislative branch can grant a true exemption, and a company's promise just means they're covering the tax expense, well, who ultimately bears that cost? Companies don't just absorb losses. That hidden tax component is usually passed on to consumers in higher prices. Or maybe it's factored into smaller raises for employees. It's a layer of hidden costs for you to think about until our next deep dive.